Hi there, welcome back. Having learned the rudiments of financial management, now it's important to then discuss the key concepts in financial management. You must have heard terms like assets, liability, equity, account receivable, accounts payable, and you wonder what this means. In this module, you will understand what it means, and not only understand, you will also be able to use those terms appropriately. Now, what is an asset? An asset is any item that you buy for the purpose of the business and is expected to last for more than 1 year. Now, in accounting, sometimes we define assets as any item that is acquired by an organization as a result of past events and from which future economic benefit is expected to flow into the organization. Then you ask yourself, what are the examples of an asset? It's important to mention that an asset can either be a fixed asset or what we now call non-current asset or a current asset. What is a non-current asset or a fixed asset? Imagine buying a delivery van for the purpose of your business. That delivery van is an example of a non-current asset or fixed asset. Why is that so? Because you expect to use that delivery van for more than one accounting year. So that is what makes it qualify as a fixed asset or a non-current asset. Then when you talk about current asset, from the word current asset, this is an asset that you own, but you expect that that asset will probably be converted to cash within an accounting year. So imagine when you stock up your business, you have inventory or stock. You expect that the stock you have bought should be sold within a particular year. So that way it qualifies as a current asset. And it's important to also mention, by the way, that International Accounting Standard number 16, IAS 16, Property, Plant and Equipment, speaks to the meaning of asset and how assets are to be accounted for in specific property, plant and equipment used for the purpose of generating income for your business. You then ask yourself, what is a liability? Asset is what you own. Liability is what you owe. Right? So think about your supplier who had supplied you, say, granite for the purpose of constructing a road, and you are yet to pay. That qualifies as a liability. You then ask yourself, just like an asset, a liability can also be a non-current liability or a current liability. So just like an asset, a non-current liability is that liability that you owe to external party and you expect to pay back over a given period of time, usually more than one accounting year. Example, you approach a bank to get a bank loan and the repayment period is 3 years. That qualifies as a non-current liability because the bank expects that you pay back that money within 3 years. Now, then what is the current liability on the other end? The current liability is simply liability you owe to external party that you expect to pay within a year. For example, an example of a current liability is if a vendor supplies you a material, for instance, and the vendor says you should pay back in 3 months' time. That qualifies as a current liability. So example of current liability is your accounts payable, accounts receivable, amongst other things. What then is capital or equity? They are used interchangeably. In a layman's language, capital is simply the money you invest in your business for the purpose of carrying out your business. Now, it's also the same thing as equity. So it's all the money you invest in your business as an owner plus all accumulated profit. Of course, you could make profit in certain years, and rather than maybe spend the profits, you can decide to plow back the money into your business. That way, it increases your capital. Sometimes in an advanced term, we call it retained earnings. Now, as a small business owner, your equity is also, of course, the same thing as your capital, like I mentioned. Then what is a general ledger generally? So general ledger is just an account you use to store or sort or summarize all your transactions. Of course, it could be your sales ledger, it could be your purchase ledger for all the goods you've purchased, and it could also be a general ledger for every other item that cannot be classified as a sale or a purchase. Then you ask yourself, what is cash flow? From the word cash flow, right? cash flow simply just speaks to the movement of money in and out of the business. For example, the cash you receive is what we call inflow or cash inflow, meaning you are receiving it, it is coming in. Cash you pay out is what we call cash outflow, meaning that the money is being expended towards maybe purchase of equipment, towards maybe running costs like your expenses, amongst other things. And it's important to mention that, of course, cash flow statement is one of the financial reports that is also important to be prepared as a business, right? And the accounting standard that also addresses that is International Accounting Standard 7. It addresses cash flow statements and, of course, every other matter surrounding cash flow statements. Then you ask yourself, what is accounts payable? Very simple, accounts payable. So your accounts payable is simply those people that the organization, your business owe, like your supplier. Why is it accounts payable? It means that you are obligated or you're under obligation to pay your supplier. That is why it is called accounts payable. You have received goods from them. You are in possession of the goods. Then it becomes an obligation upon the business to pay them. So another name for account payable is your creditor, right? So then what is account receivable? It's just the opposite of account payable. So imagine you sell goods to your customers on credits, right? And you expect to receive money from them in the foreseeable future, right? So those customers that are yet to pay you are classified as account receivable because you expect to receive money from them in the foreseeable future, having delivered the goods or service requested by them to them. Now, what you also need to understand is source documents. Source documents are just simply those documents that evidences that a transaction has occurred. Imagine when you pay a vendor, for instance, one of the things that evidences that that has occurred is when you issue a receipt, whether an e-receipt or a physical receipt. And source documents are important, particularly for the purpose of auditing, whether be it financial audit or tax audits, because those are what taxman, those are what they are interested in, and as well as accountants. So it's important to always keep the relevant documents that evidences that the transaction has occurred, because it's important for auditory. In a case where you are trying to perform an audit, it helps you to trace that transaction from inception to conclusion. So it's important to understand this. So having learned the meaning of cash flow, account receivable, asset, liability, equity, amongst other things, I am sure that what you have learned is important to understand what financial management is and to also properly manage your business as a freelancer, as a business owner, as a gig worker. Thank you very much.